welcome back to JPX and Market Weekly Updates. Oil prices came under heavy selling pressure after data revealed U.S. inflation remains at elevated levels, which increases likelihood of another rate hike when the Federal Reserve meet this week, dampening the prospect for future economic growth. Price recovered during Friday on concerns that Russia may make retaliatory cuts to crude supplies after German government seized Rosneft assets. Reports of disruption to export following an oil spill and Iraq-based report also helped to steady oil prices. Middle East benchmark Dubai crude was slightly higher on the week ending September 16th, while the sharp sell-off in Middle Distillate market stabilized heading to the weekend. The prompt market structure also firmed, with a key first-line and third-line spread around 50 cents higher on the week at $6.2 a barrel. Data from the U.S. Department showed that the Consumer Price Index climbed 0.1% last month from July, and it gained 8.3% from the year-early period. Economists had expected a small monthly decline amid falling energy prices, paving the way for the U.S. Central Bank to perhaps slow the pace of its rate hikes in the coming month. But the report showed accelerating inflation in services and a particularly worrisome rise in the cost of rent, which tends to be sticky from one month to the next. So November will be a key window to see if the Fed pivots. Economic and inflation data over the next 1 to 2 months will be crucial. The softer tone last week was also set by the IEA, which forecast that growth will continue to lose momentum, slowing from 3.5 million barrels per day in the first half of the year to only 1.1 million barrels per day in the third quarter before grinding into a halt in the fourth quarter. Global oil demand remains under pressure from the faltering Chinese demand and ongoing slowdown in OECD economies. The IEA also estimated that weaker demand was partly offset by the expectation that a significant amount of gas-to-oil switching, which is estimated to average 700,000 barrels per day during the fourth quarter and the first quarter of next year, double the level a year ago. As a result, for 2022 as a whole, global oil demand will climb by 2 million barrels per day, down 110,000 barrels per day from last month's report, before advancing by another 2.1 million barrels per day next year to exceed pre-pandemic levels. In 2022, the OECD would account for most of the total rise, while the non-OECD countries will recover 3/4 of next year's gains if China reopens as expected. The IEA estimates the global oil market will be oversupplied in the second half of 2022 by close to 1 million barrels per day and roughly balanced in 2023. Refinery throughput in China slumped by 6.5% in August year-on-year and remained close to levels from July. However, rumors emerged that China could soon issue a new batch of 15 million tons of fuel export quotas for its refiners, as the government expected to increase export quotas to take advantage of high distillate cracks. The total Chinese quota so far this year would rise to the level of whole of 2021 and would mark a V-turn in export quota policies of recent months. While crude and other feedstock demand will be bolstered in China, the additional volume would likely be made up of discounted incremental barrels from Russia. On the other hand, the huge potential volume has shaken the global product markets, especially diesel. Diesel cracks has been the mainstay of the global refining industry since the midsummer slump in gasoline margins, so the collapse in distillate values could tip many refiners into negative territory and reduce run cuts, with European refiners taking the biggest blow as they are most exposed to high energy costs. OPEC in its newly released monthly oil market report maintained its focus for strong global oil demand growth this year and next year. Oil demand is estimated to increase by 3.1 million barrels a day this year and 2.7 million barrels a day next year, based on indicators that major economies are doing better than expected, despite unfavorable factors such as rising inflation. Now, opinions among agencies and analysis on the oil market were divided amid mixed pricing signals. Although most expect oil prices to remain volatile going forward, as global oil inventories remain at a critical low level. Data from the IEA showed that global observed inventories declined in July for the third straight month by a further 25.6 million barrels and are close to their lowest level since at least 2016. After posting a sharp increase in April, global crude stock has drawn 140 million barrels, while refined products are built by 80 million barrels from May through July. While changes in the fundamentals certainly underpin these price movements, declining future market liquidity has aggregated volatility, which in turn has forced players to further cut positions. Okay, that's all for this week. For more information, please stay tuned to the JPX Energy Market Weekly Updates.